hundreds of years, fiat currencies have been the lifeblood of economies. However, these currencies do have their drawbacks. They're centralized and inflationary in nature. Blockchain has recently given birth to cryptocurrencies which attempt to solve these and many other issues within our current monetary system. These currencies are digital in nature, using cryptography for security. The blockchain enables each member on the network to validate transactions on a public ledger. Our team has been asked to evaluate two of these cryptocurrencies, Bitcoin and Ethereum, over the next 5 years in order to determine how to evaluate and allocate a $1 million cryptocurrency portfolio that at the end of the 5 years, we will have maximized our return without touching our investment.
When evaluating these two cryptocurrencies, it's important to identify how they're the same and how they're different. Bitcoin was developed in 2008 for the express purpose of delivering digital peer-to-peer payment and eliminating issues such as intermediaries and double spending. It fills a very specific niche in this market and is much more widely adopted than other competitors such as Ethereum. Ether, on the other hand, could potentially fill that same role that Bitcoin does, but carries potentially far greater utility. This is due in large part to smart contracts, which, if carried out properly and efficiently, could provide Ethereum with potentially unlimited utility. Ethereum is looking to drive innovation through the use of smart contracts, while Bitcoin has already established itself in the market and is looking to leverage innovation from other third parties. As far as similarities go, both Bitcoin and Ethereum provide complete trust and anonymity for all transacting parties, and also they have generally well-defined supplies that are mined through the solving of complex computational equations. After looking at these two currencies qualitatively, we tried to fit them into a quantitative model. Our linear regression model quickly encountered a number of problems. Primarily, there's a lack of historical inputs that we could work with in terms of forecasting. Specifically in the case of Ethereum, there's fewer than 2 years worth of data. Additionally, we found that there's a high correlation between news, hype, and speculation and the price volatility of both of these currencies.
Moving on from our linear regression, we consulted numerous industry professionals to determine which factors would play the most significant role in determining the price for each cryptocurrency. These 8 factors which we determined were used in our Monte Carlo analysis as inputs, estimating the probability of each event occurring and its potential impact on the price for these cryptocurrencies. Emerging markets, financial institutions, fintech companies, e-commerce, global business cycles, major network compromise, regulatory changes. We ran 100 unique simulations, and our results indicated that Bitcoin was the preferred investment in 58% of cases. Furthermore, we found that Bitcoin broke even in 62 of the 100 simulations, whereas Ethereum only broke even in 54. This is likely due to the high volatility in Ethereum's price, due to its lack of a clearly defined use case. Taking all of these factors together, we finally allocated 69% of our portfolio to Bitcoin and only 31% to Ethereum, netting a total return of 35% in 5 years' time.
Given the traction that these cryptocurrencies have already gained, we believe that our analysis incorporates enough variables when considering all of the applications and limitations of these currencies. While Bitcoin has enjoyed more widespread adoption by being the first of its kind, we believe that the possibility for Ethereum to find applications where Bitcoin cannot proves its value. Therefore, by diversifying our portfolio across these two currencies, we're able to minimize our risk while maximizing our return.